At the end of the last video, you're probably thinking, okay, VJ, you're saying that stocks are very risky, as in it can go up, it can go down. Short term, there's a lot of volatility. I want to clear that up really quick. If you invest in the right companies, you have nothing to worry about. But if you start investing in meme stocks or companies that are very speculative or companies that you're like, hey, it may go well, it may not. And if you're not fully 100% convinced that's a company, probably should not be investing in it. So as long as you're doing prudent investing, you're doing your research, you know what's going on, you should be good to go. But now you're probably thinking, VJ, I don't want to spend time looking at companies to invest, right? You have a full-time job, you probably have family, you have kids. You probably have so many things going on that you don't want to spend time researching companies. And I get it 100%. In fact, my professional background is in investment management. That's what the CFA is. And I should be an expert at managing money, right? But let me tell you a little secret. Most people, especially those on Wall Street, cannot beat something known as the S&P 500. Now, the S&P 500, it stands for Standard & Poor's 500. It is the 500 of the largest publicly traded companies in the United States. Now, you're probably like, VJ, what does this have to do with me? What if I told you that you don't actually have to pick individual stocks? There's a way where you can actually get exposure to the entire stock market without doing any research on any single company. So let's jump into it, and let me introduce you to the world of index funds. Again, there are two words here. There are index and there are funds. And so let's break down each one of them. Let's look at an index. So think of index like a list. Think of a grocery list, for example, right? You have milk, eggs, bread. You have a lot of items in a list. Similarly, with an index, this list is a list of stocks. So these stocks could be Apple, Microsoft, Tesla, right? And it just continues going on. And so what happened was investors wanted to get exposure to a bunch of these companies. But what happens is they don't have the money to diversify across all of these companies. So these financial service firms came out with something known as an ETF. This stands for Exchange Traded Fund. Now here it is, we see the same word again, funds and fund. So now let's talk about a fund. Think about a fund as a pool of money, right? So investors throw money into it, and there is an investment manager who manages this money. Now they could take this money and they could invest it in whatever they want, but specifically in this situation, we're going to talk about exchange traded funds, where they take this and they invest it into these stocks. So what happens is, instead of you buying each one of these stocks by itself, you would just put your money into a pool, and now you have allocation, basically exposure into all of these companies, hundreds of companies. This means you can literally get started investing into all of these companies with like $10, something super small. Otherwise, to buy one share of Apple, you need hundreds of dollars. Microsoft, you need hundreds. Tesla, hundreds, right? Now, imagine doing that for 500 companies. You would need tens of thousands, hundreds of thousands. You need a lot of money to get proper, or literally millions, to get proper diversification across all of these. So instead, what you could do, again, you take your money, you invest into a pool of assets, which is run by an index fund manager. They take it, they properly allocate your money along with thousands of other investors into, or even millions of other investors, into all of these companies, and that way you get great diversification. Now, let's look at this word right here. Exchange traded. All it means is, if you remember in the previous video, we talked about the stock market. The actual market is an exchange. It's a place where buyers and sellers can hang out basically and exchange stocks. All it means is you can go to the same place, and instead of buying a stock, you could actually buy an ETF. It works the exact same way. It trades just like a stock, but except when you buy into this ETF, you get exposure into all of these companies. Now let's look at some popular ETFs. There are hundreds or even thousands of ETFs out there, and so it's very important to pick the right one for you. And these are the three most common, most popular ETFs that we use in our own strategies and just the world uses. First one is SPY. This is the S&P 500. These are large cap companies, and it's very diversified across, and as the name says, 500 companies. But these are all US only companies. It's also very important to note that these are all publicly traded as well. As in, when you invest into the S&P 500, you're not going to get exposure to companies that are not listed on the stock market. So if you were to buy one share of SPY, you would get instant diversification across 500 of the largest publicly traded companies in the US. That's incredible, right? You don't have to go and pick individual stocks because you get instant diversification. SPY is a fantastic investment for the very long run. Just because you are diversified, yes, short term there are going to be market dips, but the cool thing is if any one of these 500 companies goes bankrupt, or if there's fraud or something bad happens, you have another 499 more companies that are most likely going to be fine, right? And these are all in completely different industries, so it's overall a very safe investment for long-term investing. Now let's look at the next ETF, which we trade. This is IWM, so Russell 2000 Small Cap Index ETF. So what does this mean? This means very similar to the SPY, you're also getting diversification, but instead of 500 companies, you're getting diversification across 2,000 companies. But there is a little bit more risk because these are all small cap companies. So what does small cap mean? Small cap just means that these companies aren't large enough to make it into these large cap indexes. Now, just the fact they are smaller, there is more risk. But again, you are diversified across 2,000 companies. So it is possible all 2,000 can fail, but it's very unlikely that all 2,000 will fail because again, these are all publicly traded companies as well. So just to get listed on the stock market, you have to go through some regulations, some hurdles. And so most of the companies that are listed on the stock market most likely aren't just brand new startups. Yes, there is significantly a lot of risky companies out there, but most likely they're not crazy. It's most likely you're not going to lose all your money. But just know that this ETF is a decent one, which I do trade personally, but there is just higher risk compared to SPY. Last ETF we're going to look at is QQQ. This is actually my favorite ETF and the one that I trade the most. There are 100 companies in this ETF, and they're mostly leaning tech heavy. And this is a great hybrid because the S&P 500 is filled with significant number of tech companies. Now, NASDAQ is mostly tech, which is good and bad, right? So it has actually a lot more volatility. It is riskier than SPY, but it is safer than IWM. So these are companies that have already shown a profitable model. They're literally worth billions of dollars. They are large cap. So it is a little bit riskier because there are only 100 companies and a large portion of this index are concentrated in technology companies, so in one specific industry. So if anything happens to that industry, a bunch of these companies are not going to do well. But a large amount of these companies are also in SPY. So let's talk about why we would invest in these index funds rather than individual companies. The biggest benefit I personally see is diversification. As in, companies can go bankrupt within these indexes and you won't lose all your money. Let's switch up the color a little bit. Also, an advantage is you'll most likely outperform individual stock pickers because, as I mentioned, picking individual stocks to outperform the benchmark, which is these indexes, are extremely difficult. Even professional Wall Street money managers cannot consistently outperform the index for over 10 years. I think the statistic was 90 or 95% of Wall Street cannot outperform S&P 500 over a 10-year time period. And so just by indexing, you're statistically likely to do better. There's less stress, as in you're not going to be watching individual stocks. You're not going to be like, oh my gosh, this company's earnings are coming out. Should I buy? Should I sell? It doesn't matter because it's going to be such a small allocation overall. You can just go enjoy life. And the whole point of this course is so you can go enjoy life, not be glued to your computer, not be looking at stock charts, not doing research. I don't want you guys to do that. I want you to learn a simple framework, which you can just copy and paste into your own investment accounts. Just go enjoy life and not worry about what's happening in the markets. So it is less stress. Now let's look at some disadvantages. And these are disadvantages compared to just buying the individual company. The biggest disadvantage I see is it's not going to grow as much as putting all your money into just one stock. But again, that has significant amount of risk. So I just don't personally think it's worth the risk to put all your money into one company and walking away. That can just shoot up. You can make thousands or tens of thousands of percents, but you're also risking way too much. So I think risk-adjusted returns, index funds are probably the best way to go. Great. So I am a huge fan of index funds for this reason. And this way you can get instant diversification. You can just walk away, go enjoy life, not worry about what's happening. And this will help you significantly as we're getting into more of the strategies later on in this course. I know this was fairly high level. That's pretty much all you guys need to see. But if you have any questions, just let me know and I'll be more than happy to help in any way I can. Awesome. I'll see you in the next video.